Welcome, deep dive investors. Today we're taking a closer look at Nvidia, NVDA, the undisputed heavyweight of the AI revolution. In 2025, Nvidia didn't just ride the AI wave, they built the surfboard, but with shares at record highs, and both competitors and politicians eyeing their throne. Is this still a golden opportunity, or could the next chapter bring more risk than reward? Let's go beneath the surface. Let's start with the basics. Nvidia, trading under NVDA, is now a $3.88 trillion titan based in Santa Clara, California. Founded back in 1993, they started with graphics cards, but today, thanks to visionary leadership from CEO Jensen Huang, they're powering the world's most advanced AI, data centers, and autonomous tech. As of September 19th, Nvidia stock trades at $176.67, up more than 33% year-to-date. Over the last 52 weeks, shares have ranged from $86.64 to a new high of $160.98. Check for split adjustments if comparing past years. The company's P/E ratio is around 50, signaling enormous expected growth. Dividend yield, just 0.03%. Nvidia is all about reinvestment and growth, not income. So, what's driving the buzz in September? Two massive headlines. First, Nvidia just launched their new Blackwell Ultra AI platform, setting off a product supercycle across cloud providers, big tech, and cutting-edge startups. Chip orders are booked out for months. Demand has never been higher. Second, breaking news. Nvidia and Intel have announced a landmark collaboration on AI infrastructure and personal computing, with joint projects rolling out as early as the first quarter of 2026. The market cheered, seeing this as a preemptive strike against rising competition from AMD, Google, and Amazon Web Services. On the financial front, Nvidia just reported Q2 2025 revenue of $46.7 billion, up a staggering 56% from last year. Their Q3 forecast? $54 billion, with AI/data center segments growing at double-digit rates. Gross margins climbed to 72%, showing unprecedented pricing power. It's not hype, the numbers are record-breaking. Data center revenues surged, driving more than half of total sales. Gaming is still a strong contributor, but AI chips for large language models, labs, and generative content tools are now the growth engine. Analysts project these AI tailwinds will last 3 more years, at least. Despite this, some caution. With a P/E ratio near 50, Nvidia must keep hitting sky-high targets. The company holds a fortress balance sheet, low debt, and $33 billion in cash. But any stumble could trigger a rapid, multiple contraction. Bull case. Nvidia's technology is embedded in every AI and cloud infrastructure roadmap on Earth. Their Blackwell platform and software ecosystem offer a deep moat, while even their partnerships with Intel show how dominant they've become. Risks? Competition is catching up. AMD and new custom chips from Google, Amazon, and Chinese firms want a slice of the AI pie. Regulatory scrutiny over pricing and export bans remain very real threats, especially with both US and China singling out advanced chips as strategic technology. And at nearly $4 trillion in value, even a small earnings miss could slam the stock price. So, is Nvidia still the best way to play the AI boom, or is this as good as it gets for NVDA? The fundamentals are rock solid. Growth is unlike anything else on the market, but expectations have never been higher. What's your next move on Nvidia? Buy, hold, or take some chips off the table? Let me know in the comments below. If you want more clear, research-driven deep dives, subscribe and join us every day here at Daily Stock Deep Dive. Remember, this is education, not advice. See you in the next episode.